Hi there. Welcome to the Global View. Wonderful to have you here with us. I'm Nadine Blaney. Let's get you across what happened on Wall Street. It did hover near record highs with the Trump trade alive and well. Tesla, for one, surged beyond that $1 trillion market value. The S&P 500 just flat. The Nasdaq reversed course after hitting a record high, and the Dow finished higher by about 0.7%, but it was the small cap Russell 2000 which really kicked it out of the ballpark. It was up 1.5% to its highest level since we last saw in 2021 November, and it was near a record high. Crypto stocks rallied as Bitcoin soared. Again, fresh record highs there, currently sitting at around 87,000. Coinbase jumped, Marathon Digital up by close to 30%, and Riot Platforms was up by close to 17%. But gold miners fell as that stronger US dollar hurt gold prices. Newmont, Barrick, Goldfields, punchy losses there. Newmont down by 6%, so we'll be watching locally listed shares here today. Top three S&P gainers were Bristol Myers Squibb, Albemarle, and Tesla. There you go, up by close to 10%. Top three losers, Monolithic Power, AbbVie, and Moderna, which was down by close to 9%. U.S. bond markets were closed for the Veterans Day holiday. The U.S. dollar was, as I mentioned, much stronger, and that saw the euro dropping to its lowest level in 6.5 months against the greenback. Investors worrying there about potential U.S. tariffs that may hurt the European economy. And countries gathering at the 2-week COP29 meeting have green-lighted global carbon credit market rules. Campaigners say those rules fail to protect human rights, but the signatories aim to fund CO2 cutting projects in poorer nations. Just a note that European share markets closed higher, logging their best day in 6 weeks, with defense stocks in the lead on prospects of higher military spending in Europe under a Trump presidency. The Aussie market is expected to open about 4 points higher, so just marginal gains. We'll be watching the tech space. Energy likely to come under pressure as oil prices fell by more than 2%. Brent crude was off by close to 3%. WTI was down close to 3%. As mentioned, gold fell on that stronger US dollar. Copper was off close to 3%. Iron ore close to 2%. And as we mentioned, Bitcoin at that record high. So let's find out what it all means with Steve Sosnick, who's joining us from Interactive Brokers. Steve, hi there. Welcome. Maybe just give us your rundown of the day. What were volumes like? Because, of course, we did have bond markets closed, as I mentioned, for Veterans Day.
Good morning, Nadine. The volumes themselves were sort of scattered. I mean, the stuff that was really in vogue was moving. The rest of the stuff was, sort of modest. I mean, the bond market, we didn't get a lead from the bond market, but stocks are doing a pretty good job of figuring out their own narrative anyway. We're seeing, the Trump trade in earnest, certainly in stock. And, you mentioned the leaders like Tesla, Bitcoin, et cetera. But some of the other aspects are not actually doing all that spectacularly. DJT stocks actually been treading water since the election. And actually, the advanced declines have actually been really quite modest. They've been more or less 3-2 each day, which when you've had a rally of, between 4 and 5% on various indices, you'd kind of think you're going to get something 5-1, 7-1, 8-1. And it's pretty mixed. And so I would say that there's definitely been, stocks in rally mode, but not all stocks all rallying together.
Okay. But safe to say we've got stocks like Geo, which was put on our radar just last week in the defense and immigration and enforcement part of the market, is doing quite well. And I had a really interesting chat with a gentleman earlier on this morning, Steve. So while we're seeing this initial reaction to Trump in Bitcoin, in Tesla, all of what we've already talked about, the point is that a lot of his policies initially will be very domestically focused. So, immigration, mass deportations, all the rest of it. Would that be, or how would markets read that if that's the first 90 days?
One of the things you pointed out in the open was that the Russell 2000 was the big winner, and that's been probably the best overall performer since then, which because it is domestically focused. If you're talking about a protectionist economy, those are the stocks that need the most protecting. Microsoft and Apple don't need a ton of protection. Number 607 of the Russell 2000 needs some protection. I have no idea what that is, by the way, but that's kind of my point: is that some of these smaller stocks would benefit from some protectionism, and so the market is taking it very much glass half full right now. I think when some of these policies come home to roost, and we'll see to what degree they do, tariffs definitely have some issues because, you know, on the one hand, they're protectionist. On the other hand, they, depending on how they're applied, they can be inflationary. They could also be there could also be retaliatory tariffs, which, as we learned from the last round of tariffs, a lot of the tariffs that went in ended up getting, a lot of their effect got washed out because China retaliated on agricultural imports, and so they subsidized the farmers, and it sort of was almost a wash. I think 90% of the tariffs ended up being recycled in aid to other areas. Deportations. That's not something we've tried on a large scale in the U.S. I do wonder, how inflationary it will be if we start removing large sectors of the workforce, legal or not. Most of these people are working, and so the question is, who performs those jobs, and how much does it cost to replace the people, or do we just sort of get services and goods crimped because of it? So these are all very much moving parts. The market is certainly willing to give the new administration a honeymoon, and we see that. But I think when the rubber hits the road, I do. That's why I want to watch the bond market, because they're much less distracted by all the other stuff, than much more focused on how these policies will affect economic growth and affect deficits in the debt.
Yeah, okay. And so that magic 5% number, US 10-year Treasury yields going above 5%, has been flagged as a potentially, because of course the inauguration not till January. We will likely have a very domestically focused agenda at the beginning, at least, of a presidency, and it will take time for what could potentially be inflationary and for fiscal policy to move the bond market. Or is that naive? Will the bond market move really to preempt some of those moves?
Very tough to say, and that's really the multi-zillion-dollar question we have here. Is the bond market sort of, in theory, we should have this honeymoon period between now and the end of the year. We've got about 6 weeks, 7 weeks left to go. We can muddle through that, and the bond market shouldn't get too unnerved by it. A lot of it has to do with how international investors view the U.S. bond market, because a lot of while we've become more internally financed than we had been, there's still definitely an international component to it. And also, bonds sort of do nothing until they don't. They then sort of have these big jumps here and there. We did have a big jump in yields as the election returns were coming in, and then sort of that faded back because there was still demand for Treasury debt. The 30-year auction went well, and so that's one of those real tipping points. We're still a good ways away from the 5% 10-year level. So it's really, does it start to move in that direction, and do people start to get a little bit unnerved? I don't necessarily see the situation being where, one that we had, like we had, let's say, in England a couple of years ago, where just there was the one day we woke up and the England market was just sort of, in free fall, the Liz Truss trade. I don't see that. And so I think it becomes more gradual. I think stocks can sort of, ignore it for a while, because you can actually argue that yields going up reflects a stronger economy. At some point, it does weigh on your ability to finance things. But again, credit spreads, I should say, remain very tight, meaning that companies can finance themselves relatively easily. And so it's something that bears watching. It's something that bears watching. And it's one of those things that can easily sneak up on you. So I would watch it very closely. But it really, it depends how much of a honeymoon period we get. I think a lot of people are recycling the 2016 playbook, except the difference is, in 2016 we were not coming in at record highs with record high valuations, record high forward PEs. So I do think it's always dangerous to say it's different this time. They're probably the four most dangerous words that any investor can say. But the circumstances are not identical to the 2016 period, and that's why I think, stocks are sort of using that playbook, but it's not clear that that's in all cases the right one to be using.
So interesting. I mean, we could talk all day, but I'll just get to something else. US dollar strength, I mean, likely to continue given what we've all just been speaking of. So what does that mean for commodities? And has gold sort of time in the sun come to an abrupt end?
Yeah, this is the problem. See, I've always felt is actually more, yes, it's an inflation hedge over time, potentially. Yes, it's a crisis hedge over time. I think it's less of a crisis hedge if you live in a country that can finance its debts using its own currencies, which both of us do. On the other hand, if you lived in, Argentina or something like that, it's been a phenomenal hedge. So gold can be disappointing that way. And so most of the time, without a lack of other things going on, it's sort of the anti-U.S. dollar since it's priced in U.S. dollars, and sort of as the U.S. dollar strengthens, gold tends to weaken unless there's something else going on. And that's I think why we've seen this correction, let's say from 2,900 down to the 2,600 range. Um, you know, the commodity picture, though, in some ways, again, since most global commodities are priced in U.S. dollars, a stronger U.S. dollar hurt that we've seen because a lot of the declines have outpaced the strength of the dollar recently. So I think that's much more about demand, global demand, and particularly Chinese demand. I think there's been some the Chinese have been trying to stimulate, but after that first wave, I think the market's been continually disappointed by the amount of stimulus that Beijing has been putting out. And as a result, I think that puts a damper on demand for world commodities. Then just throw the fact that the U.S. dollar is strengthening on top of it, and it's a pretty unhelpful situation. And then, of course, if you start to talk about, you know, deglobalization affecting global demand, well, none of that is particularly helpful for the commodities picture. And obviously, I'll defer to a lot of your viewership who have a much more direct stake in the commodity industry.
Yeah, we're feeling it, Steve. All right. Nice to see you. Always a pleasure. And we'll speak soon.
Always.
Steve Sosnick from Interactive Brokers there. So markets fascinating. You need to keep us on all day to see what happens. We are expecting to see this market rise by a modest 4 points at the open. But again, a lot of that focus will be on tech, yes, but it will also be on those big commodity plays. I mean, we saw really steep falls for the likes of BHP, Fortescue, Rio Tinto yesterday. The NAB Business Survey due at 11:30. Westpac Consumer Confidence comes before that. We have heard from Lifestyle Communities. We've heard from some of these companies already holding their AGM, with more of that news expected to trickle in this morning. That does it for this edition of The Global View. Stay with us and we'll get you across all the news you need to know from Australian corporates next.